Okay, let's look at the problems for Chapter 6. So I'm just starting with the problems. We'll do a few of them, 38 through 42, I believe is what, no, 43. We'll do 38 through 43 is the ones we'll look at. The first one here, Teal Corp has E&P of $2 million, distributes property with a basis of $150, fair market value of $400 to Grace. She owns 15% of the outstanding Teal shares. So we'll talk about tax consequences to Teal and to Grace if the distribution is a non-qualified distribution. Okay, so I'm going to do this one in Excel just so we can see the numbers a little bit better. And so I'm going to look at Teal first. Okay, so I don't type very well, so just so you know. Okay, Teal E&P. So let's go back, look at the numbers here first. So you can see here tax consequences to Teal and to Grace if distribution is non-qualified redemption. Okay, so Teal's E&P of $2 million distributes property with a basis of $150, fair market value of $400,000. So hopefully everybody saw the fair market value of $400 minus the basis of $150 would be a $250,000 gain. Okay, so we'll take gain, which is an increase to E&P. So that will make E&P go up. And then we have we're going to then also subtract $400,000, which is the fair market value. So let me just do negative $400,000, which is the fair market value of the property distributed. Okay, and then we've got those two things. So obviously it's a net decrease of $150, but then also they have a taxable gain of $250, right? So that $250 gain minus a $400,000 fair market value of the property distributed, plus just basically tax on the gain. Actually, I should say a subtraction. So we'll subtract then tax on the gain. Okay, so that will also go down for that, and I should type that in better. Here we go. Okay, so I completely blew that one. Let me fix that. There we go. So minus the tax on the gain. So it will go up for $250 gain, minus $400 for the fair market value, plus we'll subtract the tax on the $250 gain. Now let's look at this from the perspective of Grace. So for Grace, let's look at her. She's going to receive $400,000. Okay, and that would be a dividend income. Okay, so Grace will receive $400,000 dividend income, and basically that's it. Her basis on the property is also $400,000. Okay, so for Grace, she just receives a dividend of $400,000, and the basis also happens to be $400,000. Okay, let's look at B. If the parties involved could choose from the preceding options, which would they choose and why? For Teal, consequences to Teal would be the same in option A. Grace Corp would receive dividend of $400,000, but Grace Corp would receive dividend income of $400,000. Only 30% of the $400,000, or $120, would be taxed to Grace. Okay. And the reason for that, of course, is the dividends received exclusion. Grace Corp has less than 20%, it's 15%, so less than 20% ownership interest in Teal. Therefore, the 70% dividend received deduction is applicable. So basically, dividend income, basically 30% of the $400,000 would be dividend income. Okay, 30% of $400,000, which is $120, and the basis would still be $400,000. Letter C, what are the tax consequences to Teal and to Grace if the distribution is a qualifying stock redemption? In this example, assume that Grace's basis is $90,000. For teal, the consequences are the same as letter A. They've not changed, except that teal's E&P is reduced by the ratable share of its E&P attributable to the stock redeemed, which they've not given us that. So that percent's not been provided to us. Grace would receive, in this example, a little bit different for Grace though. Grace would receive a capital gain of $310, the $400,000 basis, the fair market value received, minus the $90,000 basis would be a gain of $310. Letter D, what are the tax consequences to, in Part C, if Grace is a corporation? For teal, it's the same. So for D, the consequences are the same for teal no matter, as they were in C. For Grace, they would still have a capital gain of 310. Okay, so that would still be the same. For E, if the parties involved could choose, which would they choose and why? Assuming Grace is an individual, she would choose the qualifying stock redemption option from letter C. If the distribution is a qualifying stock redemption, she has a capital gain of 310. If it's non-qualified, as it was in option A, she'd have a dividend of 400,000. Okay. Her basis of the property is the same no matter what received. So she clearly would be better off with the $310,000 gain as opposed to the $400,000 worth of dividend income. She'd pay less tax. If Grace is a corporation, it'd prefer the distribution be non-qualified stock redemption because only 30% of the resulting dividend would be taxed, which was option B. Okay, question 39. Julio is in the 33% tax bracket. He acquired 2,000 shares of stock in Gray 7 years ago at a cost of $50. In the current year, Julio receives payment of $150 from Gray in exchange for 1,000 shares in Gray. Gray has E&P of $1 million. What's the income tax liability Julio would incur on the $150 payment in each of the following situations? Assume that Julio has no capital losses. Stock redemption qualifies for sale or exchange treatment, letter A. In letter A, Julio's income tax liability would be $15,000, which is $150,000 realized, minus the $50,000 basis. Hopefully everybody saw that the acquired cost was $50 per share, and this is for 1,000 shares, so it's for $50,000. So $150 minus 50 is $100,000, and this would be a long-term capital gain. Therefore, the rate is 15%, and the tax is $15,000. Okay. Okay, so tax is $15,000 for letter A. $150 minus 50, $100,000 gain times 15% tax rate. Letter B, Julio's income tax liability would be $22,500, computed as follows: $150 dividend. I'm sorry, stock redemption does not qualify. I got ahead of myself. Income tax liability for that would be $22,500, which is just basically saying it's $150 dividend. It's non-qualified, so it's treated like a dividend now, times the rate of 15%, which is $22,500. Okay, so it's $15,000 or $22,500. Letter 40, how would you answer problem 39 if Julio were a corporate shareholder in the 34% tax bracket rather than an individual, and the stock ownership in Gray represented a 25% interest? So it'll be a little bit different situation then for question 40. For question 40, letter A, tax liability for a corporate shareholder would be $34,000. Basically, the $100,000 gain, the $150 received, minus a $50,000 basis is a $100,000 gain times 34%. So corporations do not receive the favorable long-term gain tax rate that individuals do. So individuals pay 15% on that, but corporations pay their, whatever their bracket is, 34% in this example. For B, does not qualify. For B, tax liability would be treated as a $150,000 dividend. And so the $150,000 dividend, though, would be subject to the 80% dividend receive exclusion because 25% of the stock is owned. Okay, so it's because we're at 25%, we're at the 80% dividend receive deduction. So if you take 150 times 180, you get basically 120,000, which is 30,000. So 150 minus 120, and again 120 is 150 times 80%. So that results in $30,000 worth of taxable dividends. Okay, dividends received after the exclusion is 30,000. Multiply that by the 34% rate, and we get a tax of 10,200. Okay, question 41. 41, we're going back to the same scenario. Question 39. Julio has a capital loss carryover of 150 in the current year. Julio has no other gain transaction during the year. What amount of the loss may Julio deduct in the current year in the following situations? A. The 150 payment from Gray is a qualifying stock redemption for tax purposes. In letter A, Julio may deduct the entire 50,000 capital loss carryover of 50 to offset the $100,000 capital gain. Okay. So Julio would be taxed only on 50,000 of the gain, and the income tax liability on the 50,000 long-term gain would be 7,500, which is 50,000 times the 15% rate. So it'd be 7,500 for the tax. So basically, $100,000 gain minus $50,000 carryover, and then 50,000 times 15% is 7,500. For B, non-qualified. Okay, so Julio could then deduct only 3,000 of the capital loss carryover to offset ordinary income. So he can only take 3,000 of that carryover to offset ordinary income. His income tax liability on the dividend would be 150 times 15%. Okay, 150 times 15%. So he can offset that 3,000 for ordinary income at his regular tax rate, but he still would have to pay 15% tax on the dividends of 150. For letter C, if Julio had the flexibility to structure that transaction as described in either A or B, what form would he choose and why? The preferred outcome for Julio would be the one that provides sale or exchange treatment, which is option A, because clearly he's got less tax. So in letter A, his tax was 7,500. In letter B, his tax was 2,250. I'm sorry, 22,500. Letter B was 22,500. So therefore, he's better off with option A. Question 42, how would your answer to parts A and B of problem 41 differ if Julio were a corporate shareholder in the 34% bracket rather than individual shareholder and the stock ownership was 25%? So now he's a corporation as opposed to an individual. The corporation could offset the entire, for letter A, the corporation could offset the entire $50,000 capital loss carryover against the $100,000 gain. So only $50,000 worth of gain would be taxed, just like it was for the individual part. However, the difference is that corporations do not receive the favorable tax rate of 15% that individuals do. So he has to pay 34% of $50,000, which is a $17,000 liability. For B, the corporation, so now it's non-qualified. For B, the corporation could not deduct any of the capital loss carryover. Corporations can only offset capital losses against capital gains. So none of that carryover comes in handy in this example. So we'll treat it as dividend income less the dividend received deduction. And because 25% is our magic number, the dividend received deduction is 80%. So 80% of 150 is our deduction of 120. And so 150 minus 120 is a $30,000 dividend multiplied by 34%, which is $10,200. Okay, one more, question 43. Silver Corp has 2,000 shares of common stock outstanding. Howard owns 600 shares. Howard's grandfather owns 300 shares, his mother owns 300 shares, and his son owns 100 shares. In addition, Maroon Corp owns 500 shares. Howard owns 70% of Maroon Corp. Letter A, applying Section 318 stock attribution rules. How many shares does Howard own in Silver Corporation? Let's do that one in Excel. Okay, so I'm just going to scroll down here a little bit. And let's just think about Howard here for letter A, question 43. So directly, so we're looking at Howard. And let's go with direct. And Howard directly has 600. Okay. His mother counts, that's 300. And his son counts, which is 100. Okay. Also what counts is Maroon Corp. Okay. And for Maroon Corp, I'm just going to type it in here. There's 500 shares at Maroon. And then Maroon owns 70%. So, or Howard owns 70% of Maroon. So that's 350. So basically, 500 shares, 70% owned. So the sum of all of those then is 1,350. So letter A, the answer is 1,350. Letter B, assume that Howard only owns 40% in Maroon. How many shares does Howard own directly and indirectly in silver? Okay, so a little bit different situation here. So now we're down to 40%. So the stock attribution rules do not apply to stock held by corporations if the shareholder owns less than 50% of the stock in that corporation. Okay, so I take out Maroon. That just goes away because now the scenario is down to 40%. Okay, so now it's just 1,000. So basically, in the first example, letter A, he owned 70. In B, he owned 40. So for letter B, we do not include anything out of Maroon. So now it drops to 1,000. Letter C, assume the same facts in A above, but in addition, Howard owns 25% interest in Yellow. Yellow owns 200 shares in silver. How many shares does Howard own directly or indirectly in these? And the answer now just becomes, for B, we add basically 50 more shares. So let's go back to what I showed you. And so let's go back and show the Maroon number here. Okay. And now we're just going to add Yellow. And for Yellow, I didn't spell that right, but we'll just leave it. It's 200 shares at 25%. Which is 50. So now my new number for part C is 1,400. Okay, so that was 43. So that was all the problems I wanted to go over with everybody. As always, if you have questions about anything, just let me know. Thanks.